Silver prices hit new surge. Fed rate hold, Middle East crisis breakdown. Something just shifted in the global metals market, and most investors have no idea what's coming next. The Federal Reserve just tipped its hand. Rate hike odds collapsed almost overnight. But that is not the real story. While Wall Street watches interest rates, a far more dangerous signal is building in the Middle East. Oil, the dollar, and silver are now moving together in a pattern history has seen before. Every time this pattern has appeared, it has ended the same way. And tonight, we break down exactly what it means for your money, your savings, and what happens next. Welcome to Currency Arc Insight, the channel dedicated to decoding the economic signals that shape real wealth. If this is your first time here, hit subscribe and join a growing community of serious investors preparing for what's ahead. Drop a comment below and let us know which city or country you're watching from tonight. On a quiet trading day that few expected to matter, silver quietly did something significant. The metal climbed to $65.82, a modest gain on the surface, yet one that carried far more weight than the numbers alone suggested. Gold moved in tandem, rising past $4,374, confirming that this was not an isolated fluctuation in a single commodity, but a broader shift across the entire precious metals complex. For the casual observer, a fractional daily gain in silver might seem unremarkable. But for those who study the mechanics of global capital flows, this small movement represented the visible edge of a much larger and more consequential story, one that connects central bank policy, currency valuation, and the psychology of international investors in ways most people never stop to consider. The catalyst behind this rise was not silver itself. It was the United States dollar. On the day in question, the dollar index slipped beneath the symbolically important level of 100, falling to 99.65. To the untrained eye, a decline of a few tenths of a percent might appear trivial. In reality, this threshold carries significant psychological and structural weight in global markets, and its breach set off a chain reaction that rippled through commodity markets worldwide. The reason lies in a mechanism that professional investors understand intimately, but that remains largely invisible to the general public. Silver, like gold, is priced globally in United States dollars. When the dollar weakens, silver effectively goes on sale for every buyer transacting in a currency other than the dollar. A softer dollar functions as an automatic discount, instantly making silver more affordable across international markets, from Asia to Europe to the Middle East. This is not speculation. It is arithmetic, and it explains why a currency moved thousands of miles away from any mine or refinery can trigger a wave of buying interest that shows up directly in the price of physical metal. This single mechanism, often overlooked in mainstream financial coverage, is precisely why serious investors track currency strength as closely as they track the metals themselves. A weakening dollar does not merely affect exchange rates. It reshapes global demand patterns for tangible assets in real time, often before most market participants even recognize what has occurred. What makes this particular moment worth close attention is not the dollar's decline in isolation, but the timing of that decline. It arrived just as market expectations for future Federal Reserve policy were undergoing a rapid and substantial shift. Only days earlier, the probability of a rate hike at the Federal Reserve's next policy meeting stood near 55%. That figure has since fallen to roughly 31%, a dramatic repricing of expectations in a remarkably short window of time. This is where the story begins to take on strategic significance for anyone paying attention to the broader economic landscape. A falling dollar and a retreating central bank are not two separate developments occurring by coincidence. They are two expressions of the same underlying shift in how markets are interpreting the health of the American economy. When investors begin to doubt the need for higher interest rates, capital naturally begins searching for alternative stores of value, and precious metals have historically been among the first beneficiaries of that search. For the business community and for entrepreneurs building long-term financial strategies, this convergence deserves careful attention rather than casual dismissal. Markets rarely announce turning points with dramatic headlines. More often, they reveal themselves through quiet, incremental shifts, exactly the kind observed on this day. A currency slipping below a key threshold, a metal edging toward levels not seen in weeks, a central bank narrative beginning to change shape. Individually, these developments might appear unremarkable. Together, they form the opening chapter of a much larger economic story, one that will demand a closer examination of exactly why the Federal Reserve's hand is being forced and what that forced hand ultimately signals for the months ahead. There's a persistent myth in modern finance that the Federal Reserve operates from a position of complete control, calmly steering the economy through deliberate, forward-looking decisions made in isolation from market pressure. The events unfolding this month tell a very different story, one in which the central bank appears less like an architect and more like an institution responding almost reactively to data it cannot ignore. The shift began with a single, unassuming economic release, the July non-farm payrolls report. On the surface, employment data rarely generates the kind of dramatic headlines reserved for wars, elections, or corporate collapses. Yet within financial markets, this particular report functioned as a quiet detonator. The reading came in weaker than anticipated, signaling that the labor market, long considered one of the last remaining pillars of economic strength, was beginning to soften. This single data point did not exist in isolation. It arrived alongside a consumer inflation reading that came in largely in line with expectations, neither alarming nor reassuring on its own. But when combined with the weaker labor data, the two figures told a coherent and consequential story. Inflationary pressure was not accelerating, while the broader economy was showing visible signs of strain. For a central bank, whose primary justification for maintaining higher interest rates rests on the need to combat inflation, this combination effectively removed the foundation beneath its own policy stance. The market's reaction was immediate and measurable. Expectations for a rate hike at the Federal Reserve's upcoming September meeting collapsed from 55% to just 31% within a matter of days. This is not a minor recalibration. It represents a fundamental repricing of how professional investors, institutional trading desks, and algorithmic models interpret the central bank's next move. When the probability of tighter monetary policy falls this quickly, capital begins to reallocate accordingly. And that reallocation was visible almost instantly across currency and commodity markets alike. To understand why this matters so profoundly for precious metals specifically, it is necessary to examine their relationship between interest rates and non-yielding assets. Silver and gold generate no interest, no dividend, and no coupon payment. Their appeal is rooted entirely in scarcity, tangibility, and their historical role as stores of value. When interest rates are high, holding cash or bonds becomes relatively more attractive, since those instruments generate a guaranteed return that silver simply cannot match. But when the probability of higher rates diminishes, the opportunity cost of holding metals falls in tandem, and capital that might otherwise flow into yield-bearing instruments begins drifting back toward tangible assets instead. This is precisely the mechanism now playing out in real time. As rate hike expectations receded, several major financial institutions, including Commerce Bank, began publicly noting the improved upside potential for silver under a scenario where the Federal Reserve maintains its current stance rather than tightening further. This is not fringe commentary from speculative corners of the market. It reflects a broader institutional recognition that the balance of risk has shifted, at least for now, in favor of precious metals. What makes this development particularly significant is not simply that the Federal Reserve appears likely to hold rates steady, but the underlying reason why. A central bank choosing restraint from a position of strength, confident that inflation is contained and growth remains resilient, sends a fundamentally different signal than a central bank that finds its options narrowing due to weakening economic data. The current situation increasingly resembles the latter, an institution responding to deteriorating labor conditions rather than proactively managing a stable economy from a position of comfort. For entrepreneurs and business leaders monitoring these developments, the lesson extends beyond the immediate price of silver or gold. It is a reminder that monetary policy, often perceived as slow-moving and predictable, can shift rapidly when underlying economic fundamentals begin to erode. And as this next section will explore, the Federal Reserve is not the only force now shaping this unfolding story. A far more volatile variable, originating thousands of miles away in the Middle East, threatens to complicate this entire narrative within a matter of weeks. Every economic narrative eventually encounters a variable that refuses to behave predictably. And in this unfolding story, that variable lies not in a boardroom or a central bank meeting, but in one of the most strategically sensitive waterways on the planet. The Strait of Hormuz, a narrow passage through which a significant share of the world's oil supply has historically moved, has seen transit volumes collapse to roughly 10% of pre-conflict levels. For anyone tracking the intersection of energy markets and precious metals, this single statistic carries implications far beyond the region itself. To understand why this matters, it is necessary to move past the assumption that geopolitical tension automatically benefits precious metals in a simple, linear fashion. That assumption, while intuitive, oversimplifies a far more intricate relationship. Geopolitical instability does tend to drive capital toward traditional safe havens, and silver has historically benefited from this flight to safety during periods of uncertainty. But this same instability carries a second, less obvious consequence, one capable of undermining the very conditions that have allowed silver to rise in recent weeks. The consequence is energy-driven inflation. With Hormuz transit severely restricted, crude oil has been trending upward, recently climbing past $82 per barrel. Rising oil prices do not remain contained within energy markets. They filter into transportation costs, manufacturing expenses, and ultimately consumer prices across the broader economy. This is the mechanism through which a regional conflict thousands of miles from Wall Street can quietly reshape domestic monetary policy in the United States. Herein lies the strategic tension now facing markets, and the reason this variable deserves such careful scrutiny. The Federal Reserve's recent shift toward a more accommodative posture rests heavily on the assumption that inflation remains contained. Should oil prices continue climbing as a direct result of restricted Hormuz transit, that assumption could unravel quickly. Renewed inflationary pressure, driven not by domestic demand, but by external energy constraints, could force the central bank to reconsider the very rate hold stance that has recently supported precious metals demand. This creates what can accurately be described as a dual-edged dynamic. On one side, continued Middle East instability reinforces silver's traditional role as a safe haven asset, drawing cautious capital away from riskier instruments. On the other side, that same instability threatens to reignite the inflationary pressure that could ultimately reverse the Federal Reserve's current trajectory, undermining the low-rate environment that has made silver more attractive in the first place. Two forces, born from the same underlying event, pulling in opposite directions simultaneously. This is precisely the kind of complexity that separates careful economic analysis from surface-level market commentary. It is not enough to observe that tensions are rising and conclude that precious metals will automatically benefit. The more disciplined approach requires tracking the specific transmission mechanism, in this case, the path connecting restricted oil transit to rising energy costs, to renewed inflationary risk, to potential monetary policy reversal, and recognizing that this chain remains fragile at every link. There remains, of course, genuine uncertainty about how the situation develops. Diplomatic negotiations, shifts in regional alliances, or unexpected de-escalation could alter this trajectory just as quickly as it emerged. Markets have already demonstrated their sensitivity to headlines suggesting progress toward a resolution, with brief periods of oil price relief triggering corresponding shifts in metals pricing. This volatility itself is instructive, illustrating just how tightly interconnected these markets have become. For business leaders and entrepreneurs seeking to understand where capital may flow in the coming weeks, the lesson is not to draw simple conclusions from complex geopolitical developments. Rather, it is to recognize that the current environment supporting precious metals rests on a foundation more fragile than headlines suggest. The same Middle East tensions currently reinforcing silver's appeal could, within a matter of weeks, become the very force that undermines it entirely. Understanding this fragility is essential to interpreting what comes next, as the final piece of this analysis reveals a historical pattern that has appeared before under strikingly similar conditions. History rarely repeats itself in exact terms, but it frequently rhymes closely enough to serve as a warning for those willing to study it carefully. The current convergence now visible across global markets, a weakening dollar, a central bank retreating from further tightening, and an energy market destabilized by geopolitical conflict, is not without precedent. Similar combinations of forces have appeared before, and in each instance, the outcome carried significant consequences for anyone holding capital in traditional currency-based assets. The pattern typically unfolds in a recognizable sequence. First, economic data begins to soften, prompting a central bank to step back from further monetary tightening. This shift alone tends to weaken the domestic currency, as reduced interest rate expectations diminish the returns available to foreign capital holding that currency. Precious metals, freed from the pressure of rising yields on competing assets, begin to attract renewed investor interest as a result. Then, almost inevitably, a second force enters the equation from outside the immediate control of monetary policymakers. In previous periods, this force has taken different forms: an oil supply disruption, a regional conflict, a breakdown in international trade relationships. In the current environment, that role is being filled by the sustained disruption to Strait of Hormuz transit and its corresponding upward pressure on global oil prices. This second force introduces a new inflationary threat precisely at the moment when the central bank has signaled a willingness to ease its stance, creating friction between two conflicting economic pressures operating simultaneously. What makes this pattern particularly worth studying is not its rarity, but its recurring structure. Each time the specific combination has emerged, a period of monetary accommodation colliding with externally driven inflationary pressure, financial markets have experienced heightened volatility, and precious metals have played a central role in how capital repositioned itself during the uncertainty that followed. This is not a guarantee of any specific outcome, but it is a signal that deserves serious attention from anyone managing meaningful capital. It is important to approach this pattern with appropriate caution rather than certainty. No historical parallel unfolds identically twice, and predictions built on past patterns can fail when new variables enter the equation. Diplomatic breakthroughs, unexpected policy interventions, or shifts in global trade relationships could all alter the trajectory currently in motion. Serious analysis requires acknowledging this uncertainty rather than presenting speculation as inevitability. That said, the strategic implications of this convergence remain worth careful consideration. If oil prices continue climbing as a result of restricted Hormuz transit, the inflationary pressure generated could force the Federal Reserve to reconsider its current posture far sooner than markets currently anticipate. Such a reversal would not only affect interest rate expectations, but could trigger a broader repricing across currency markets, bond markets, and commodity markets simultaneously, exactly the kind of environment in which capital typically seeks refuge in tangible, historically resilient assets. For the business community, entrepreneurs, and serious long-term investors, the value of this analysis lies not in predicting an exact price target or a specific timeline, but in understanding the underlying mechanics well enough to recognize the pattern as it develops in real time. Markets rarely provide clear warnings before major shifts occur. More often, they offer a series of quiet signals, a currency slipping below a key threshold, a central bank narrative changing shape, an energy market destabilized by forces beyond anyone's immediate control, that only become obvious in hindsight to those who failed to track them as they emerged. The current environment offers exactly this kind of signal. Whether it ultimately resolves through diplomatic de-escalation, a sustained inflationary surge, or some combination of unforeseen developments, the underlying lesson remains consistent. Capital preservation, in an increasingly interconnected and unpredictable global economy, requires more than reacting to headlines. It requires understanding the mechanisms connecting currency valuation, monetary policy, and geopolitical risk well enough to recognize when history is beginning to repeat itself, and to position accordingly before the pattern fully reveals itself to the broader market.